In this video, we're going to expand on trend reversals, how to identify them and what to do when you see them. So again, let's keep things simple here. There's two main labels that you need to denote trends as they continue. Each time the low gets broken in a downtrend or each time the high gets broken in an uptrend. It's called break of structure. You can mark that as BOS. So, BOS equals trend continuation. A reversal, on the other hand, or when the trend shifts, it always begins with what is called a market structure break, a change of character or a trend shift, or a trend reversal. You can use any of those that you wish, pick whichever one works for you. I personally use market structure break, okay, MSB, but pick whatever you want. The only point of it is for you to differentiate between trend continuation and trend reversal. So the reversal always begins with a market structure break or change of character. The reason some people call it a change of character is because the characteristics of the previous move have now changed, meaning the previous pattern of lower lows and lower highs, or higher highs and higher lows, has changed. And the break of structure as well as the MSB or change of character is always measured using candle closes. If you don't wait for candle close confirmation, it is not a valid break of structure or a valid market structure break. And it's possible that the move is just a sweep of liquidity and not truly the shift or continuation that you're actually looking for. So with that out of the way, let's look a little deeper into it. So this is a line chart, and the line chart only measures price based on candle closes. So the line will not move until there is a candle close, and then we go into the next time period. It ignores wicks, and in a second I'm going to show you the exact same chart but with candlesticks, with the candle bodies and the candle wicks, so you can see a difference to see why it's important to use both. I want you to watch the blue line in particular in the next slide to show you how important it is to focus on the closes. So you have highs in an uptrend, and when they break, it's a break of structure, and that denotes continuation. And eventually, when the price trades back down to the previous swing low, it's a market structure break or a change of character. And that shifts us into a downtrend or the opposite trend. Okay? Now, let's view the same chart but with candlesticks. You probably immediately think that this just got a lot more messier, okay? And so this should serve as a reminder to always keep in mind your line charts. If this looks cleaner to you, if this makes more sense to you, if you could just watch this and say, well, actually price came all the way down here and bounced back up to there, I could have conceptually got short much easier because I can see a very clear and distinct break. I can see a very clear change of character from what it was doing before, and that makes sense to me. And viewing it with candlesticks, like most of the majority of you are, or the way most traders view it, it might actually introduce more noise than signal, meaning it might be more confusing than it is helpful. But the part I want you to look at is the blue line. So of course we have our breaks of structure, which if you view it with wicks and candle bodies, it's important to note the break of structure is not when this high gets taken, it's when the candle close gets closed through by another candle. That's a break of structure. You then set your structure line level, your highest high, on the candle close, and when that breaks, it's a break of structure. So these together form what becomes this on the line chart. Now on the way up, of course, you want to mark your lows because they denote your market structure level. They denote your swing lows, which we will talk about in a second, okay? And so you're marking these lows, and so you're marking this low and marking this one, which I want to highlight. So this was the low, the candle close of the lowest low before the next break of structure. On the candlestick chart, we can come down, and if you see closely here, the wick of this candle actually goes below the structure level. But note, when I say that this is not a market structure break, this is not a change of character, okay? And this does not indicate a reversal because wicks are to be ignored on these moves. An easy way for me to prove that this is true is to go back here and show you how it looked like on the line chart. Structure remained intact, nothing changed. Uptrend continued, okay? So have both. Use both. They're very easy to use, okay? Both of the charts. They're there for you to use. So toggle between the two, have the two open and use them. And once you get confident enough later on, you can start using the candlestick charts, and you'll be able to pick it up using just the candlestick charts, and then eventually these things will just stick out to you and you won't even have to look for them anymore. Eventually you have to progress onto the candlestick charts anyway, and after that time it's important to view it on candlesticks, because you are trading an asset that has a lot of long wicks. You can't just ignore the wicks, because they denote other things like liquidity grabs, stop hunts, things of that nature, okay? So you need to be aware of the wicks. You can't just trade on the line charts forever. And eventually you just be able to use the candlesticks and it'll be fine, okay? Now, let's talk about swings. This is a very misunderstood part of market structure, and this is the part that will probably have the most impact to you as a trader, so listen up. First, let me define what a swing is. Sometimes you're going to see multiple highs or lows in a wave, and that'll tell you to focus on a swing low or a swing high as a confirmation of the market structure level. And what does that mean? A swing is the entire wave between two breaks of structure. So everything from this previous high all the way to the break of structure, this entire box, everything inside this box is a swing. Same for this. From the high until the high breaks, these are the swings, everything that goes on in these squares. The consolidation, the chop, whatever you want to call it, all of that in between is the swing. And why is this important? Because you have to identify the swing low in an uptrend or a swing high in a downtrend in order to properly gauge when the market structure has shifted. So the swing is the entire wave between two breaks of structure. The swing low or the swing high is always the lowest low or the highest high after the previous break of structure. We can call these other highs and other lows that are not within it interim lows or interim highs. So you have your swing low and your interim low in this uptrend. What does that mean? It means that you might have noticed in, for example, this swing low, we have a low, but we also have this other low right before the breakout. So you might say, which one of these is my market structure level? And similarly, here we have this swing low where the red line is here, where the market structure break occurs. But you might have said, we also have this low which is right before the last pump. So why is this not my market structure level? This is why I say to focus on a swing low. So everything inside the box, the lowest point of that, and the other ones are interim lows, okay? So there you pretty much have it. And the way to trade this is to look back. If it seems confusing, don't worry, it'll come to you with time. You don't have to guess these ahead of time. You look backwards. So every time there's a break of structure, I want you to go back and look at the entire swing before you mark your swing low or high and mark your interim low or high, meaning that if you were here on the chart when this breaks and it closes up here and it confirms the break of structure, you then go back and say to yourself, okay, this is my interim low right before the breakout, but this was my swing low, which was the lowest low after the previous high. You had a high, you went down as far as here, and then you went all the way up to here. That's your swing low. Your interim low is important, but your swing low is the only thing that you can cause what we're really looking for, which is the market structure break or the change of character. Interim breaks can give you early signs of a reversal, but the swing itself must break in order for it to be valid. It is a swing low or a swing high which causes what we call the market structure break, or again a change of character. So mark your swings and have the lows. You'll notice that in these ones at the beginning of the trend, it's a bit cleaner. because the swing low itself is our lowest low before the breakout. So in times like that, it's nice and clean and it's nice and easy, but the market isn't always clean and it's not always as easy. Sometimes your swing low will be your ultimate low. Sometimes your swing low will have another low in front of it, like these ones. So you need to understand what both are, but you have to put priority on the swing low, which is why I'm emphasizing it so much. If you go back and look at the candlestick version of that for now, on candlesticks that will look like you have your down candle, which is your swing low, because if you look at this and imagine from the high of the previous breakout structure here all the way around, see as a swing, okay? As it consolidates, dips down and goes up, but right before the pump we have another red candle, a down candle. That is your interim low because it's occurring within the swing. You still have your main structure level at the swing low, so swing lows, swing highs, okay, they're very important. A key part of market structure, especially when you get a lower time frame, because you're going to have many breakouts on the mini time frames, okay? Essentially impulse interim lows and interim highs breaking, but it's only when the entire wave between the two breaks structure, it's only when that breaks that you consider that the trend might be shifted. Everything else is just noise, okay? And often, just like this one here, it's not going to break by just a little bit. It will often give you a pretty big sign. Look at this, a really clear break, okay? This is very obvious, and look, it came back up for a retest, clear breakdown, nice retest. So again, you don't have to rush, you don't have to FOMO into these. There's lots of time, you can wait for confirmation. Do not let market dictate your emotions, okay? So we've marked our interim lows or swing lows, and we have reinforced that only swing low or a swing high can cause a market structure break or a change of character. Very important, okay? Finally, there is a rule. Every trend shift begins with a market structure break or a change of character, but not every structure break or a change of character is a trend shift. Remember that we deal in probabilities, not certainty, meaning sometimes this will happen, okay? The markets are not perfect again. If it was that easy, everyone would be rich. So in this instance, a valid swing low breaks, but instead of failing and going lower, the market goes higher. This happens and happens quite often. This is what you might look at as a liquidity sweep, a stop hunt. The market dips down and traps people before going higher. So you can have failed market structure breaks. You can have failed change of character, but every single trend shift will begin with a market structure break or a change of character. Every trend shift will have to have one because you cannot shift trend without that happening. But not every time that you see one will result in a trend shift. So think on that deeply. Think on that. It's very important to understand how that will help you if you understand that, if you internalize it, okay? It will help you to not get upset when inevitably your market structure break or your change of character will fail. The point is not to be 100%. The point is to get as high as a percentage possible below 100% so you can retain profitability, because having 100% success in trading is just impossible. This is particularly important because on lower time frames, meaning like a 1 minute chart, a 5 minute or a 15-minute chart, there are many of these failed breaks than there are on higher time frames. These occurrences are actually quite rare on a 4 hour, 1 day, 1 week or a 1 month chart, and that is simply because on a lower time frame it is easier for the smart money to push price into areas that show fake strength, or in this case fake weakness. Take the stops of day traders and then just reverse. Look at it that way. How hard is it to move price below 3 daily candles? Well, you have to go through 3 daily candles, so 72 hours worth of price action, billions and billions of dollars of volume just to get to wherever you want to go. But if you're looking at a 5 minute chart or a 1 minute chart, you've only got a fraction of the price action to go through. Probably hundreds of thousands, maybe millions of dollars worth of volume, which for the smart money and the big players is not hard to manipulate, and it's not hard to move at all. And so therefore you have many of these fake outs, many more false breaks, manipulations, stop hunts. They're trying to trap people by showing fake weakness or fake strength in order to gather liquidity and push price where they want it. That is their ultimate goal. So that summarizes the video. Hopefully you took something.